Today, we are diving deep into one of the most critical life skills that simply isn't taught enough in schools: financial literacy. You might be wondering, why does this matter so much? Well, think about this statistic. Nearly 70% of lottery winners actually end up broke within just a few years of winning. That is staggering. It proves that having money isn't the same thing as knowing how to keep and grow money. Financial literacy is the ability to understand and effectively use various financial skills, including budgeting, investing, and managing debt. It's not just about getting rich quick. The real goal here is financial stability and independence. Over the next 50 minutes, we are going to walk through every single aspect of your financial life, from setting goals to understanding your paycheck, mastering credit, and finally, building long-term wealth. Grab a notebook because we are building your financial roadmap today. Let's start where all great achievements begin, with the right mindset and clear goals. Page 2 of our guide focuses on money mindset and setting goals. You can't hit a target you can't see. Financial goals generally fall into 3 buckets. First, you have your short-term goals. These are things you want to achieve in just a few months, maybe buying a new phone or snagging expensive concert tickets. These are the quick wins that keep you motivated. Next, we look at medium-term goals. We're talking about a timeline of 1 to 5 years. This is where you start planning for bigger life events, like saving up for a car or putting away money for college tuition. Finally, and perhaps most importantly, are your long-term goals. These are the plans that span 10 years or more. We are talking about the big dreams, buying your own house or building a retirement nest egg. Visualizing these distinct timelines helps you allocate your money properly. You wouldn't invest your rent money in the stock market, right? Understanding the difference is step 1. Now let's get practical. You got a job and you got your first paycheck. But wait, the number on the check is way lower than the salary you were promised. What happened? Page 3 breaks down income, gross versus net pay. There's a big difference between the two. Gross pay is your total earnings before anyone touches it. This is the salary figure you negotiate during your interview. But then reality hits in the form of deductions. Your net pay, often called your take-home pay, is what actually hits your bank account after taxes and benefits are subtracted. And those deductions aren't just disappearing into thin air. They include federal and state taxes, and FICA, which covers Social Security and Medicare. You might also see deductions for health insurance. The reality check here is simple but harsh. You do not keep every dollar you earn. Knowing your net pay is crucial because that is the number you must build your budget around. Speaking of deductions, let's talk about the T word, taxes. Page 4 gives us a quick crash course on understanding taxes. There are 3 forms you need to know by name. First is the W-4 form. You fill this out when you start a new job. It tells your employer exactly how much tax to withhold from each paycheck. If you withhold too little, you owe money later. Withhold too much, and you give the government an interest-free loan. Next is the W-2 form. This is the summary of your yearly earnings that your employer sends you every January. You need this to file your taxes. Finally, there's the 1040 form. This is the actual form used to file your tax return with the IRS. Why do we pay all this? Well, taxes fund our roads, schools, military, and emergency services. It's the price of admission for a functioning society. Okay, you know what you earn, and you know what you pay in taxes. Now, how do you manage what's left? We are on page 5, the art of budgeting. Tracking your expenses is widely considered the first step to wealth. A fantastic framework for beginners is the 50-30-20 rule. Here is how it breaks down. 50% of your income should go to needs. These are the non-negotiables: rent, food, and utilities. If you lost your job tomorrow, these are the bills you must pay to survive. 30% goes to wants. This is the fun stuff: entertainment, dining out, hobbies. Life isn't just about saving. you need to enjoy the journey too. The final 20% is for savings and debt repayment. This is your future you fund. If you can stick to these ratios, you are already ahead of the vast majority of people. Now, before you go spending that 30% on wants, stop. Look at page 6. We need to talk about the emergency fund. Life is unpredictable. Cars break down, people get sick, and jobs get lost. An emergency fund is a cash reserve specifically for these unexpected expenses. Your target? You should aim to have 3 to 6 months of living expenses saved up. Why? Because this fund prevents you from relying on high-interest credit cards when things go wrong. It turns a financial disaster into a mere inconvenience. Think of it as your financial shock absorber. Let's move to page 7 and cover banking basics. Where do you actually put this money? You generally have 2 main tools: checking and savings accounts. Think of your checking account as the wallet. It's for high activity, paying bills, swiping your debit card, and getting cash out. Money flows in and out of here constantly. Your savings account, on the other hand, is the vault. It's for low activity. It sits there, it's safe, and ideally, it earns a little bit of interest. One major warning here: watch out for overdraft fees. This is the penalty the bank charges you for spending more money than you actually have. It's a complete waste of money, so keep an eye on that checking balance. Page 8 introduces arguably the most powerful concept in finance: the power of compound interest. Einstein reportedly called it the 8th wonder of the world. Compound interest is when you earn interest not just on your initial principal, but also on the accumulated interest you've already earned. This causes your money to grow exponentially rather than linearly. Look at the graph on the screen. See how the curve shoots up over time? That is the magic. But here is the secret ingredient: time. Starting to invest at age 18 versus age 30 can literally make $1 million difference in your final retirement number. The earlier you start, the less you have to save to reach the same goal. Now we enter dangerous territory: credit cards. Page 9 asks the question: credit cards, friend or foe? Credit cards use revolving credit. You have a borrowing limit. You can spend up to that limit, and you pay it back monthly. The principal is the amount you bought, and the interest, or APR, is the cost you pay for borrowing that money. If you are not careful, the interest can crush you. But if used correctly, credit cards offer security and rewards. The golden rule? Pay the full balance every single month. If you do that, you avoid interest entirely, and the card works for you, not the bank. How you handle that credit card directly impacts page 10, the credit score. Think of your credit score as your adult report card. FICO scores generally range from 300 to 850. A high score unlocks the world. A low score shuts doors. It affects your ability to rent apartments, buy cars, and get loans. What makes up this number? The biggest chunk is your payment history, 35%. Did you pay on time? Next is amounts owed, 30%. Are your cards maxed out? Then comes length of history, 15%. This is why you shouldn't close your oldest credit card accounts if you can avoid it. Keep that history alive. We often hear that debt is bad, but page 11 clarifies that it's more nuanced. There is good debt and bad debt. Good debt is money borrowed to buy something that increases your net worth or generates value over time. Examples include student loans for a degree that increases earnings, or a mortgage for a house. Bad debt is the opposite. It loses value and often comes with high interest. Using a credit card to buy luxury clothes or a vacation you can't afford, that is bad debt. You also need to watch your debt-to-income ratio, which measures how much of your monthly pay is eaten up by debt payments. Keep this low to stay healthy. Moving on to page 12. We need to distinguish between saving versus investing. Saving is for safety. It's liquid, meaning it's easy to get to, like cash in a bank, but it offers a low return. Investing, however, is for wealth creation. It is riskier, but it offers higher returns for long-term growth, like stocks or real estate. Why can't you just save cash under your mattress? One word: inflation. Inflation means that the purchasing power of your money decreases over time. $1 today buys less than $1 10 years ago. Investing is how you beat inflation and actually grow your wealth. So how do we invest? Page 13 introduces the stock market. When you buy a stock, you are buying an ownership share in a company. If the company does well, you might get a dividend, which is a share of the profit paid out to shareholders. You'll hear two animal terms often. A bull market means prices are rising, optimism. A bear market means prices are falling, pessimism. Despite the ups and downs, the historical average return of the S&P 500 is around 10% per year. This is why long-term investing is so powerful. But investing can be risky if you bet everything on one company. That brings us to page 14, diversification and mutual funds. The rule here is simple. Don't put all your eggs in one basket. Instead of picking one stock, you can buy mutual funds or ETFs. These are essentially baskets containing hundreds of different stocks. This lowers your risk significantly because if one company in the basket fails, the others can balance it out. It's the safest way for beginners to enter the market. Let's look far into the future with page 15, retirement accounts. The key message: start early. In the US, you have powerful tools like the 401k. This is an employer-sponsored plan. The best part? Many employers offer a match. If you put in money, they put in money. That is literally free money. Never turn that down. Then there are IRAs. A Roth IRA uses post-tax money, meaning you pay taxes now, but your withdrawals later are tax-free. A traditional IRA is the opposite. You get a tax break now, pre-tax, but you pay taxes when you withdraw the money in retirement. Let's come back to a major medium-term goal: cars. Page 16 discusses the cost of transportation. When buying a car, you must look at the total cost of ownership. It's not just the monthly payment. You have to pay for insurance, gas, maintenance, and the silent killer, depreciation. Here is a painful fact. A new car loses about 20% of its value the moment you drive it off the lot. This is why buying used is often financially smarter. Always consider the full picture, not just the sticker price. Page 17 touches on another massive expense: higher education and ROI. You need to treat education like an investment. Calculate your ROI, return on investment. Compare the tuition costs against your expected future salary. Does the math work? Remember, student loans must be repaid even if you don't graduate. Don't blindly sign up for debt. Consider alternatives like trade schools, community college, or apprenticeships if the ROI isn't there. Page 18 is about protecting what you've built. Insurance, managing risk. Insurance is about transferring financial risk from you to a company. You pay a premium, the monthly cost, and in exchange, they cover you if disaster strikes. You also have a deductible, which is the amount you have to pay out of pocket before the insurance kicks in. Essential types include health, auto, renters, homeowners, and life insurance. Don't skip these. One accident can bankrupt you without them. Page 19 covers consumer protection and scams. As you build wealth, people will try to steal it. Be aware of identity theft, where bad actors use your info to open accounts. Watch out for phishing, fake emails or texts asking for passwords, and Ponzi schemes, which promise fake high investment returns. How do you stay safe? Freeze your credit. Use strong, unique passwords and check your bank statements regularly. Vigilance is key. We've arrived at the final page, the path to wealth. It all boils down to a simple formula. Spend less than you earn. This creates the gap. Then, invest that difference wisely. Wealth building is not a get-rich-quick scheme. It is a marathon, not a sprint. You need patience. And remember the most important rule of all. Consistency is greater than intensity. It's better to save a small amount every single month for years than to save a huge chunk once and then stop. Thank you for joining me on this 50-minute journey through financial literacy. If you apply these principles, budgeting, avoiding bad debt, investing early, and protecting your assets, you will be well on your way to financial independence. Don't forget to like and subscribe for more deep dives into mastering your money. See you in the next video.